All right, welcome to The Explainer. Today, we're diving into one of the oldest, maybe one of the most argued about tools in an investor's entire toolkit, the price-to-book ratio. Now, this thing promises to help you find amazing bargains. But here's the catch. It can also lead you right into a financial trap. So let's figure out why that is.
I mean, this is the million-dollar question, right? How do you actually spot a real bargain in the stock market? You know, that one diamond in the rough, the hidden gem that's trading for way less than what it's truly worth. Well, for decades, a lot of investors have turned to one specific metric, hoping it held the answer.
And that tool is the price-to-book ratio, or just P to B for short. For a long time, this has been the go-to for value hunters on the prowl.
Okay, so what is it, really? At its heart, the PB ratio is actually beautifully simple. You just take the company's current stock price and you divide it by its book value per share. So, in other words, you're comparing what the market thinks a company is worth with what the company's own accountants say its net assets are worth. It's basically Wall Street versus the bean counters. But this is where things start to get complicated. Because this simple little ratio, it's a total double-edged sword. On one hand, it could point you toward an absolutely incredible deal. But on the other hand, it could just as easily steer you straight into a value trap. And to really get why, we've got to break down the two parts of the ratio that are constantly at odds with each other.
And that brings us to the core conflict here, the price versus the books.
So, on one side of the ring, you've got the market price. This is the market's verdict, right? It's emotional, it's volatile, it's always looking ahead to the future. It literally changes by the second. And then, in the other corner, you have the book value. This is the accountant's view. It's stable, it's based on history, it's looking backwards. It's only updated 4 times a year. So you have this clash. One is fast, emotional, and forward-looking. The other is slow, deliberate, and backward-looking. And that fundamental conflict, that's where all the power and all the problems come from.
Okay, so let's talk about the good stuff first. The promise of finding amazing value. This is the reason so many investors have fallen in love with this ratio.
The classic signal, the holy grail for some, is finding a company with a price-to-book ratio that's less than 1. What does that mean? Well, in theory, it means the company's stock is trading for less than the actual value of all its assets. It's kind of like finding a crisp $1 bill on sale for just 90 cents. I mean, who wouldn't take that deal? For a value investor, that's the smell of a serious bargain.
But not so fast. This is the other sharper edge of that sword we were talking about. A super low P/B ratio might not be a bargain at all. It could actually be a massive red flag. It might be screaming that the market knows something that the accounting books don't reflect yet. You know, things like plummeting sales, or assets that are becoming worthless, or even deep financial distress. Suddenly, that 90-cent dollar you thought you found, it might just be a counterfeit.
And all this brings us to a really critical question. Especially today. In our modern economy, is the price-to-book ratio even the right tool for the job anymore?
You know, the biggest weakness is really baked into the book value part of the formula. For starters, it's based on historical cost. That means if a company bought a piece of land 50 years ago, it's still on the books for what they paid way back then, not what it's worth today. It also totally ignores a company's future growth potential. But the real killer, the biggest issue for today's economy, is that it completely fails to capture the most valuable assets for so many companies, things you can't touch. They're intangible assets.
And this chart just shows the problem perfectly. Take a look. For an old-school manufacturing company, you can see the book value and the market value are pretty close. The book value is a decent guess at its real worth. But now look at the tech company. Whoa! Its real value isn't in buildings and machinery. It's in its brand, its intellectual property, its code. And almost none of that is properly counted in the book value. This creates a gigantic gap you see here, which can make the PB ratio almost useless for some of the most important companies in the world today.
So you might be thinking, okay, if this tool is so broken, why are we even talking about it? Well, the answer isn't to just throw it out. It's about learning how to use it wisely, with skill.
Okay, rule number 1, and this is the big one. Context is everything. PB ratios are absolutely not one-size-fits-all. You just can't compare the PB of a bank to a software company. That's not even apples to oranges. It's more like apples to airplanes. It makes no sense.
You have to compare a company's PB ratio against its direct competitors in the same industry and against its own history.
And look, this table just drives that point home with real-world numbers. It's pretty wild. Over the last decade or so, you've got MasterCard, a financials and tech company with an average PVV of almost 43. Then you have an energy giant like ExxonMobil, heavy on physical assets, averaging just 1.4. And then there's Berkshire Hathaway, the classic value play, averaging even less than 1. This just proves, right here, that what counts as high or low is completely dependent on the specific industry and the company's business model.
All right, you're ready for a pro tip. If you really want to understand what the P/B ratio is telling you, there's a key formula you need to know. Think of this as the secret key that unlocks what's really going on under the hood.
Here it is. Price to book equals the PE ratio times return on equity, or ROE. So what does that actually mean? It means a company's PB ratio is really driven by two things. First, its profitability, that's the ROE, and second, the market's expectations for its future, that's the PE ratio. So a company with a high PB isn't just expensive for no reason. It means either it's incredibly profitable, or the market thinks it's going to grow like crazy, or maybe both.
So let's wrap this all up into a simple game plan. First, never use the P/B ratio all by itself. Always compare it against its industry peers and its own historical trends. Then, combine it with ROE to get a read on profitability. And most importantly, you have to investigate why the number is what it is. Be skeptical of numbers that look way too low or way too high. Bottom line, you have to be a detective, not just someone who reads a number off of a screen.
So when it all comes down to it, the PB ratio isn't some magic wand that just points you to treasure. It's a diagnostic tool. It's like a doctor's stethoscope. In the wrong hands, it's just a piece of metal. But in the right hands, it can tell you a lot. It helps you start asking the right questions, but it's never going to give you all the answers by itself.
And that really leaves us with one big final question to think about. Our economy is being built more and more on ideas, on code, on brands, not just on physical things. So given that, does an investor's toolkit filled with these classic metrics need a major upgrade to keep up?